Hi, everyone. Welcome, welcome, welcome. We are so thrilled that you are here. Oh, and we have special guests today from an IRA company called Kama, and they say they have very special ways for you to come into their company and grow your wealth. And of course, the Roth, we know, doesn't pay taxes, but we're going to let Kama tell you how wonderful they are and what they have to offer to you. And then you can ask questions as we go along. They'll do a presentation and then get your questions ready. Write them down. Thank you very much for coming. Take it away, Carl and Samantha.
Hey, thank you very much, Peggy. I appreciate it. Are we sharing the screen?
Yes, if you'd like to share the screen.
Okay, cool. So we are Kama Plan, and today I'm going to talk a little bit about tax-free income for life and, with commercial real estate, because that's one of the things I like to do. And let me see if I can, put it in presentation mode. Can you see the screen as just the screen or not?
Yeah, I shared the other side of the presentation. We're seeing the presenter side.
Okay. Let me see if I can. How about now?
No, we don't see it shared at all.
No. We try to share the screen again. We'll go to screen one. What do you see now? Do you see it now?
It's all blue.
Just your desktop.
Okay.
You had it up before.
Yeah, I know. I don't know.
There you go.
Yeah, when you went full screen, you
went
shared the
that
wrong
way.
side of the presentation.
Okay, let me try it again. Screen two, or maybe that's screen one. Is it on there now?
Nope.
Now?
Not yet.
Oh my God.
There you go.
Sorry about the technical difficulties there.
Yeah, it might be good if you just share it straight from this instead of presentation mode, because it seems like you're not able to find the primary screen.
All right, let me see. Does that work? No.
Nope.
You had it, and then you just switched to another application.
Okay.
We don't see it at all anymore. It's your email.
You
Okay.
had it working before. There you go.
Is it working there now?
Yes.
Yeah, just go from here instead of
Okay.
showing presentation.
The slides,
Yeah.
Carl.
All right, sounds good. Wasted a few people's minutes. I hate that, and I apologize. All right, so Kama Plan and its representatives are not attorneys, licensed accountants, tax professionals, or financial advisors, although we do continuing education for those people. We don't offer any tax or asset advice or any investments or sell any products. We're a neutral third-party administrator of your IRA, 401ks, so that you can make more or have more choices in your types of investments. And the ones we're going to talk about today primarily are real estate, and specifically commercial real estate. We don't endorse any products or investments, and we just want to be part of people's professional teams. So we're going to talk about using and understanding self-directed IRAs, 401ks, types of investments that you can make, how simple the process is, and tax considerations and the resources associated with it. And as Peggy said earlier, we will have Q&A at the end of it.
Great.
So people always ask me, what is a self-directed IRA or 401k? And Wikipedia has a 2-page answer. This is a simple one. I had an attorney draw up for me, but basically it's an account that lets you invest in pretty much anything that you'd want to invest in, except life insurance and collectibles. So what I find and a lot of our clients find is the key benefits of having one of these accounts is investing in what you know and understand and can control versus using hope as a strategy. We find so many people that say, yeah, I just put money into my 401k or my IRA. Somebody's advising me on what to buy, and I don't take the statements out until it's tax time, and I'm hoping I'm going to have money when I retire. People get to be 50 years old. They think that strategy hasn't worked for them and they're looking for something different. Other people start out younger and using the self-direction and their knowledge. And most of them do better than even with the advisors. The other thing that I want people to understand is I'm talking about tax-free today because I like tax-free better and I'm biased towards tax-free. My mom and dad were in real estate and their moms and dads were in real estate. My kids are in real estate. I'm in real estate. So I like having that real estate tax-free. I like the rents coming in tax-free. I like when I sell the property to not be paying long-term capital gains on it and things like that. So I want you to understand that you can do this in the traditional accounts as well as the tax-free accounts. But again, I told you I'm biased towards tax-free, so I'm going to lean that way probably in this presentation. But either one of these plans are good for that. People say, you know, which IRAs should I have? And I said, as many as you can, as many 401ks, educational savings accounts, and tax deferred and tax free. And by the way, you can combine these accounts to purchase real estate or lend money, et cetera, as we go down there. This is kind of a difference between a 401k versus the IRA. We can make this slide available if anybody wants it. Just give me your email in the chat box and we'll send you out a PDF version of this. But there are advantages and disadvantages to both the solo 401k or even the regular 401k and a self-directed IRA. I'm not going to go through all of them for the sake of time today. But here's something, right? I went to an Ivy League college, paid, you know, overpaid for my education probably. But here's some of the things they didn't teach me, right? There's different kinds of money out there, and I'm not talking, you know, difference between the American dollar and the won. But here in the U.S., if you make $100,000, what are you able to keep? W-2s, you know, 1099s. You get to keep about $60,000. Most people are in that category. You pay about 40% in taxes or more. The feds, you know, it's 0 to 37%. States are 0 to 10. I mean, California is a 10% state, right?
10%. Oh, I think it's higher than that.
So it might even be higher. When we did this slide, it was 10%. And then there's local taxes, like Philadelphia has a 4% local tax. And then if you have your own business, you're paying another 15.3% tax in Social Security and Medicare. So out of your 100,000 that you make at your job, you're getting to keep 60,000. The reason I like real estate is because I get rid of the Social Security and Medicare. I get to take depreciation on a lot of it, so that saves me some money. Granted, I have to pay back depreciation when I sell the property, but I call this passive income. And just by taking off the Social Security and Medicare tax, I get an extra $15,000 in my income. So if I had the choice of making 100,000 at W-2 or making 100,000 on rental income, I would choose the rental income. And that's why a lot of people are buying passive income. And then you go down to the tax deferred account. If you make 100,000 in the traditional account, you get to keep that 100,000. You get to reinvest that 100,000. Whereas in these other two, you're only being able to reinvest 75,000 or 60,000. So the tax deferred account, you get to reinvest the whole 100,000. But the problem is when you take that money out at age 73 now, or after age 59 and a half, you have to pay tax on that 100,000. And I don't know what tax rate you're going to be at that 100,000, when you're pulling that out. So I personally, again, go into the tax-free because I don't care what tax rates go. It's one variable less that I have to worry about in the equation. So I have been and continue to try to convert as much to my Roth IRA as possible, and I have been over the years. So I really like this chart, and I want people to start thinking about earning money in their tax-free accounts versus trying to get a little raise in the W-2 category. And I remember an economics class at Cornell where they said, on some of the questions, disregard taxes. What's the answer going to be? And that's the only place in my life I've been able to disregard taxes, was in college and on economic tests. So this was a hard lesson when I learned it. So if you take these accounts and you start off with $50,000, and let's just go out and say we go out 40 years, that $50,000, and I think it's a 10% return, is worth $2 million in the Roth IRA. It's actually worth $2 million in the traditional IRA, but if you pull that money out, you're going to be paying, in this case, we said 33% tax, I think. And if you did it with your personal money, you'd only have 750,000. So you make the exact same investments, but when you're 20 years old, you take 15 or 20 minutes to open up an IRA or a 401k. You have a significant difference when you retire, in each one of these categories. Obviously, if you're in a higher tax state, this is less. If it's less, then it's more. But I think these all took a 30% tax rate. So types of investments: real estate, notes and mortgages, private placements, and a lot of people use private placements for multifamily 800-unit apartment buildings and things like that. Precious metals and other investment types are out there. Again, I told you that I really like real estate and real estate related assets. So I don't mind putting a mortgage, a note and a mortgage on a property, because it's easier for me as I get older to manage the property. Private placements, again, if you pick them wisely. And I think, Peggy, you have a lot of classes that talk about how to look at private placements. So if they're in real estate, I feel comfortable doing those investments. And you can do single family or multi-unit homes, apartments, condos. I have some industrial property in some of mine. I used to have land in there, but we improved that land somewhere along the way. And I use leveraged and unleveraged property for several reasons in my real estate. And I do that all in my IRAs and primarily in my Roth IRAs. I've converted properties in my traditional IRA to Roth IRAs and saved a lot of money there as well. I do mortgages and promissory notes, trust deeds, and you were talking a little bit about that earlier with tax deeds. So all of those are allowed to be done in your IRAs, 401ks, et cetera. So you can see that a lot of people that are limited to stocks, bonds, and mutual funds now have a higher probability of having more assets to invest in. And if you're in the real estate or entrepreneurial group, then you're able to utilize this into assets you know and understand and feel comfortable with. I'm much better at real estate than I am at stocks and bonds. And I've tried to educate myself on stocks and bonds. And if any of you stay up at late or used to, there used to be a program you could buy online and it would give you a red, yellow, and green light when you're supposed to buy the stocks. I tried that for a while, but I bought a book and blackjack and used it instead. I felt more comfortable doing that. You have LLCs, limited partnerships, different corporations, no S corps, joint ventures. So all of these things at some point in my life I've used primarily in the real estate environment. But these are most of the things, and then obviously some people are liking gold and silver and the precious metals nowadays. So we do have more clients buying those types of investments. So I want to just take a minute and talk about, because before I knew about Roth IRAs, I had, personally owned buildings. And this is what I found for them, because a lot of people say, well, I don't get to take the depreciation. And I said, yeah, you're right. Unless you leverage it, then you can take it. But I would rather pay no taxes than get some depreciation benefits that I have to pay when I sell it. So if we take these two buildings and compare them, right, and we say both owners are 60 years old, the net rental income's $100,000 on the building. It's worth $1 million. Depreciation is zero over here. Depreciation on the building is 30,000. So income tax is, at the 30% rate of 70,000. 100 minus 30 is 70,000. So you're paying $21,000 in taxes on my personally owned building. And this is pretty similar to what I really have on my tax returns. So the owner gets to use $79,000 out of that this year. Over here, right, there is no depreciation, there is no income tax. The $100,000 in rent goes into my account, and I get to use that $100,000. So right there, every year I get a 20% or 21% better return. That's actual cash in my pocket that I can use. And then somebody says, well, what about when you sell it? I said, well, selling it is even gravy, right? Let's just say you've owned the building for 30 years. Your depreciation is down on this one to almost zero. Over here, you haven't taken any depreciation. It doesn't matter. And you sell both right? You sell the building for $3 million. Over here under the Roth building, what do you net? The total $3 million. There is no long-term capital gains. There is no recapture of depreciation, et cetera. Whereas over here, you get to net $2.25 million. So $750,000 or $750,000 is out of your account at this point in time. So I just don't see any difference in there. If somebody really wants the depreciation, they can take their building, make a distribution to themselves out of their IRA, and then start taking the depreciation on a $3 million building once they take it out of their IRA. But I still don't see the advantage of doing that, and nobody's shown me one there. I always end up with more money leaving it into the Roth. There are some prohibited investments, like I said in the beginning, collectibles and life insurance. No collectible coins. There is minted gold, et cetera, that can be used for that stuff. The other thing is there's no self-dealing and no personal use if you buy a piece of real estate. So if you're buying one down at the Jersey Shore or in Malibu on the coast, it has to be an investment property. You don't get to use it even in the downtime on that. So just remember there are rules that have to be followed, and there's persons that are disqualified that you can't sell to your IRA. Like my IRA, and that's a question that a lot of people ask, is where I said my building I had before I knew about IRAs, I can't sell that personal building that I own to my IRA. That's called self-dealing. I can't buy my parents' property or my grandparents' property or my children or grandchildren's property. Now, I can deal with my aunts and uncles and cousins, brothers and sisters. The IRS may not think those are family members or don't define them as family members, but my mother sure would. But in IRS rules, these people are not disqualified. So the people in green are not disqualified. Navy blue, they are disqualified persons. How does it work? It's pretty simple. You open up an account with Camaplan, you fund your account from a contribution, a transfer from another IRA, or a rollover from a 401k. You choose the type of investment we talked about. And in my case, I like commercial real estate. That's what I would probably choose today. You make your investment, you fill out the paperwork just like you normally would, except the purchaser of the property or the investment is Camaplan for the benefit of your name IRA. Once you're happy with the paperwork, Camaplan signs that paperwork on behalf of your IRA and sends the funds to the title company as required. And then you sit back and look at the rents coming in or payments from notes, etc. And it's a very simple process at that point. When it comes time to sell it, you tell us to sell it, show us the contract that you've negotiated. We sign it on behalf of the IRA as the seller. So just a quick on what Camaplan does. The IRS requires you to use a third party to open up an IRA. We're a neutral third party. As I said in the beginning, we don't give you investment advice. There's no way we can know what properties in Texas, California, Seattle, Florida, New Jersey, Indiana are valued. So don't ask us, ask an expert in those areas, ask a realtor or an appraiser in those areas. And then we do all the paperwork so that these assets are held in your IRA, and you report to the IRS just like you would any other IRA account or 401k account. And again, we want to be part of your core team of professionals. We'll do consultations with your accountants and attorneys so that they understand everything that individuals would like to do. And people that are raising money like this because they have access to trillions of dollars, almost $32 trillion in tax advantage plans. So here's a couple of questions that are up there, but I think we've had enough time to take questions. If that's good, Peggy. I can't hear you. Are you muted?
I am muted.
Okay.
It's better not to have interruptions or people sneezing while you're speaking, etc. So thank you very much for this great presentation. We really appreciate it. And let's see if anyone has any questions. So if you stop sharing, we could see people who raise their hand. Bill Quigley. Thank you, Carl.
So yes, I have a question. If you want to pull any money out of your self-directed IRA for personal use, you pay taxes at that point?
Yes, you do. Yeah, whether it's in real estate or whether it's in stocks or bonds. Yep. I mean, yeah, there's IRAs, IRA, it's the same rules everywhere. I mean, if you're 59 and a half, you won't pay penalties, but you will pay taxes on a traditional, but not on a Roth.
So let me ask you a question on that, because I don't know if the rules have changed, but there was a time when you could borrow the money for 90 days and at the end of the 90 days, return it to your IRA. Is that still in place?
That was 60 days and it still is in place, but you can only do it once a year now. They've limited that.
Okay. So Bill, keep that in mind. You could borrow the money for 60 days and then return it.
To your IRA without any penalties or any taxes.
Exactly.
Good idea. Yeah.
And is there any reason that you can't use your IRA to do what you're doing? So that's another thing to think about. And you can always check with your IRA company to see if that is a approved kind of investment.
Yeah, if you have any questions, feel free to give us a call. Samantha can put our phone number in the chat box. Or
Yeah,
just
that would
go
be
to
great.
camaplan.com and take a look at our website.
Fidel,
Yes, thanks for the presentation. Very interesting. I do have a question. I don't know if I missed this or you said it. Can you convert properties already on a traditional into a Roth IRA?
Yes, if you have them in a traditional IRA, you can convert them to a Roth IRA. If you own them yourself, then you can't, but you can convert a property from a traditional to a Roth. And you know, there was a lot of people that did that in 2008 and 9.
Yes, because I do have a couple of properties on a traditional self-directed IRA, and I didn't know that you can convert that one. So, I mean, what are the steps to, or, I mean, is there any
It's pretty
penalties,
simple.
of course?
No penalties. What you'll do is you'll get an appraisal for it. You'll take that appraisal to your custodian, your administrator of your self-directed IRA, and you'll fill out a conversion form and you'll say, convert this building from this traditional account and put it in my Roth account. And then you're going to get a 1099 that's going to take that value, and obviously you'll have to pay taxes on it, you know, that year, that tax year for it. But now it'll be converted to a Roth, and all income from that in the future will be tax-free. And a young man like you has a lot of years left to make that up.
and can he do a partial?
Sure. Yep, you can do a partial. I mean, let's say you want to do it over 5 years, you could do 20% each year.
Perfect.
Yep.
And we call
Yeah,
that.
I knew that you can do it with money, but not with properties already. So thank you.
Yeah,
Yeah,
no,
you
you
can do
can,
it with a property.
yeah, that's what he said. But, and the good thing is that, you know, you can maybe fudge the appraisal a little bit. You know, cash is cash, so you know what that is. And if you wait for real estate to go down and hit a low point, that's probably a good time to think about it.
Got it.
If
Noted.
you can time that market.
It's a few years away, but it's on its way.
Okay.
Everywhere.
Anything else, Fidel?
Nope, that'll be great.
Okay,
Thank you so
great.
much.
Thank you, Fred.
Hi, yeah, great presentation, Carl. I was wondering when you contribute like an asset, a real estate asset, or purchase a real estate asset in the name of the Roth IRA, how's the tax calculated when that goes in? Is it just based on the fair market value or appraised value?
Well, number one, you can't contribute a property to your IRA, but if your IRA has money in it and then goes and buys a property, you'll still have to pay property taxes on it. But you know, you'll put the fair market value in there, and if it's in a Roth IRA, when you sell it, all that money comes back and there is no tax. Or you leave it there for your heirs and they use it for 10 years, and then they'll take it out of the IRA and put it in their personal names.
Okay, so there's no tax due at the time that the property is purchased.
No.
What if that property starts producing cash like rental income inside the IRA? if that's withdrawn by the owner of the IRA, that's still non-taxable, right? Because it's a Roth?
Correct. I mean, as long as they're 59 and a half.
Right,
Yeah.
right, okay.
I mean, the name of this presentation is tax-free income for life. So that's what I'm using it for. I mean, that's the beauty of it. And that's when you saw on that one chart where it was 750,000 versus 2.25 million. That's
Okay,
the difference, because you get to use that money every single year too. You're not paying it to the tax sharks.
Right.
So
I think in one of your slides, you said that an IRA, I can't remember if it was a Roth or a traditional, but you said the IRA can hold shares in an LLC.
Yep.
Can those shares be contributed to the IRA, or does it have to be set up within the IRA?
Well, again, you can't contribute anything to an IRA except cash. So, but you could purchase those LLC shares or that percentage of the LLC as long as it wasn't owned by you or a disqualified person.
Oh,
But if you were buying from you know, some of Peggy's investments, you could definitely do that.
Okay, so in any activity that puts a real estate asset inside of a partnership or an LLC or anything, that has to happen outside the IRA, and then the IRA purchases those shares with cash that I'm guessing or assuming that the owner of the IRA has to contribute in there or put in there.
Correct.
Okay.
Yeah.
Okay, I think I understand that.
It's almost like if you just were a partner in somebody else's deal, you're going to go into an LLC, and your IRA's going to put that in the name of your name custodian in the LLC. So it wouldn't make a difference whether it's all yours or if you're a partner in the deal for the IRA company, if that makes any sense. Does that make sense to you, Fred?
I wasn't sure if you're asking me or Carl, or saying that to me or Carl.
No, to you.
Can you say that again? I'm sorry, I was
Yeah, so it doesn't matter to the IRA company, the LLC. You could be a partner with somebody else's, or it could be all your LLC partnership, just you as a single LLC owner. Your IRA would be the owner. Same as if you were a partner and you invested with someone else, you're going into their LLC. It would be in your name in the LLC. I'm not explaining it well.
I'm following you.
Yeah,
I'm
yeah.
just
Okay.
I'm just one. Go ahead, Carl.
You could buy it, you know, as an example, not even using an LLC. You could buy it, you know, and Peggy would be your partner, and Peggy would buy it, you know, with her personal money, and then you wanted to use your IRA, and you'd each put $500,000 into it, and the deed would read, Camera Plan for the benefit of Fred's IRA, 50%, and Peggy 50%, Peggy personally 50%, or both of you could own an LLC 50-50 or 60-40 or 30-70, whatever you wanted, and then that deed would be written in the name of that LLC, right? But both of you would own it as being owners of the LLC. Does that make it clearer, Peggy, you think?
Fred's the one that needs to know that.
Yeah, I follow that thinking, that logic.
Okay, where's
Thank
Mark?
you.
Mark had his hand up. Did he get tossed
Hey,
out?
thanks for the presentation, Carl. That was great information. I was
welcome.
just going to ask a technical question about how these properties are titled, but I think I got the idea from the discussion that just took place. So thank you.
Good.
Great. Thank you, Mark. Kristen.
Hey, Peggy. So my question was, at first I was thinking, so you must need to have the full amount for purchase sitting inside your IRA or 401k, your qualified account, in order to make the purchase. but then as Peggy shared some of her information, you could do like a fractional purchase. You wouldn't have to have the full purchase amount.
You wouldn't have to have the full purchase amount if you had partners in there or somebody else wanted it. But the other thing that's cool, and I didn't cover it because this was a, quick 101 primer, but your IRA could actually borrow money from a bank that has to be a non-recourse loan. But, let's say you were buying something for 500,000 and you put 250 of your money down, you could borrow 250 from a bank as well.
I guess
Your IRA would be there. It wouldn't be on your Social Security number or anything. You would tie it back to the IRA's tax ID number. But you would have to pay what's called unrelated debt financed income. So in that situation, there could be a tax on your IRA income.
so that's a way to get around contribution limits to the IRA.
A little bit, yeah.
Interesting.
I mean,
Yeah, I was thinking, how could we allow this strategy to really benefit younger people? But it's a matter of building the account in these manners.
sure.
Continuing to leverage and build it that way.
Yeah, and some of the things that I do with it is I'm breaking up my IRAs. I used to have them set up where I had one IRA and I split it between my 4 sons. Now what I'm doing is splitting my IRAs and giving them to each one of them and letting them work deals in it. And because I'm over 59 and a half, when they make that money, I'll take a distribution and somehow it'll work its way down to whoever that is. So it's a way to get that money to younger people now. There's mathematicians and there's engineers, and I've known both of them. I graduated as an engineer and launched rockets, and I listened to the mathematicians, and they just take numbers and they work hypothetical things like turning the universe inside out, etc. Engineers look at how to use those numbers to build and build things. And that's the same way I approach the IRAs. How can we use this to benefit, your heirs, your loved ones, etc. So, I work with a lot of pretty smart accountants and attorneys, and we've learned a lot of those types of strategies over time.
We'd like to know some of those smart CPAs, because everybody I know is very unhappy with their CPA and their financial advisors. So we're looking to see if we could find some that are smart enough to come on our show and explain things to people about how to build, not how to get rid of. And they know about how to do, and they know about 1031 and those taxes, etc.
Gotcha. Well,
So
maybe
Kristen,
we can talk later.
Yeah, Kristen, do you have any other questions?
No, that was actually very helpful.
Yeah, it's really too bad that people can't put in what they want to put into their IRAs, that they're limited on that because it takes a very long time to build something.
Well,
And-
the other thing you can do is you can the IRS is trying to make it harder and harder, but you can overfund your IRA and pay a 6% penalty on the overfunding of it. And then, maybe 3 or 4 years later, take it out.
Yeah.
So you're only paying the 6% per year.
Do you have to pay on it every year?
Yes.
What is wrong with that company? I'm talking about the government. They're going to do everything they can to make sure you can't get ahead. Oh, no opinion there. Okay.
Nobody's touching that one, Peggy.
Cliff.
So I would imagine, one way to get around the limits might be, taking old employer-based 401ks or 403bs or TSPs and rolling that into a self-directed IRA, maybe even doing a backdoor Roth conversion. And if you're self-employed, setting up a solo K instead, you have a lot more flexibility with that.
Absolutely. And that's one of the reasons I had that 401k on there, right? I mean, if you're over 50, you can put, 67,000 into a 401k versus 7,000 into an IRA. Now, the other thing that people say is, which one of these should I have? And in that case, I'm thinking, do both of them, right? Put the 67 into the 401k and the 7 into the Roth, and then throw some money into an HSA and an ESA, and then do one for your spouse and kids. And I had one client that had 9 kids and had Roth IRAs and educational savings accounts for them.
I
Or
think
you
if you're
happen to
over,
be- Also,
go ahead, Kristen.
Go ahead.
I was just going to say, I think if you're over 50 for that solo K, you could put up to $22,500 a year into it Roth based, right?
Yes, salary deferred, and then depending on how much you made, that's how much more could be in there, and you could have a company match as well.
And if I was going to add, if you happen to be, a very successful business owner, you might be a good candidate for a cash balance plan, in which case we can contribute, potentially hundreds of thousands of dollars per year.
Correct, and you can self-direct those as well.
Mm-hmm.
My wife does one of those.
And what is that?
Cash balance plan. So sorry, go ahead, Kristen.
It's cash balance plan. It's just another layer of retirement plan. After you do the 401k, the profit sharing, then if you still need more, deductions, then we could layer a cash balance plan on top of that. And that's where you can put into up to about 300,000 a year potentially.
Well, that's great. Thank you, Kristen. Cliff.
Carl, I heard you mention HSA. I'm familiar with that. What's an ESA? I'm not familiar with that one.
It's a Coverdell educational savings account.
Okay. And what is the benefit of that?
Now that they modified the 529s last year, it is less valuable, I think, because the 529 does more, but it's just another savings account that you're able to use. You're only allowed to put $2,000 in it a year per kid, but it's another way to get more money that you can control and put into real estate, and you get to use that from kindergarten through postgraduate school until they're 30 years old. The other thing is it's pretty easy to flip it to one of our clients, the one that had the 9 kids actually, that had the ESA, got a scholarship to college, so didn't use his ESA, and then pushed the ESA down to one of his brothers. But then the guy that went to college graduated, got married, and had a kid of his own. So some of the ESAs that weren't used by his brothers and sisters were then pushed to the new kid.
Yeah, the
grandchild.
My understanding is the Coverdell, there's no capital gain tax on it, whereas on the other one there is capital gain tax.
On the 529, yeah. But
Yep.
you can put more money into a 529.
And I think that they just modified the 529. So after 18 years or 18 years of age, I can't remember which one, you could convert that to Roth, I believe is what I remember reading.
We'll have to check that out.
Yeah.
But the Coverdell, you could invest it in all the capital gain it makes is not taxable. That was the good thing. The other was if you make too much money, and I don't know if they changed the rules on that, you couldn't you couldn't do a Coverdell for your kids.
No, but the grandmother or the grandfather could contribute to it, and your company can contribute to it, but you personally can't contribute to it. There's so many loopholes in there. It's again your favorite company is making rules. And
Okay.
It's kind of like, why do you have to do a backdoor Roth?
Exactly.
Why do they make it that hard?
Thank you. Cliff, that's it? Yes, Nika.
I actually have a question for Kristen about the cash balance plan. I was wondering, is that deferred?
Is it deferred comp, you mean, or?
Is it, well, I mean, when you put it in there, is it deferred if you grow it and you have to pay taxes on the back end?
Deferred, yes.
Okay.
It's not tax-free.
No.
Yeah, it always starts out tax deferred and then you could convert it.
Okay. Excellent. Thank you.
And you have to pay taxes when you convert it.
Exactly.
Yep. So they still get their taxes.
Yeah.
I have a question for Carl. You said something about you got out of everything, so you didn't have to make any more contributions to Medicare or Social Security, which eventually becomes Medicare when you hit a certain age. Are you now disqualified from having Medicare coverage when you hit whatever that age is? When it's 62 or 65?
65. No, I actually have Medicare. But what I was saying is, I spent more time on my real estate because I got right on the money I made from real estate. I didn't have to pay the Social Security and Medicare on the rent income because it's passive income. So it just saved me 15% versus having a job, right? I mean, if I have a job and I double my income, I'm going to pay more on the taxes, especially since now they're taxing the Social Security and the Medicare even higher, right?
Yes. Okay. Oh, I just wanted to be sure because there are people who work for the county or the state and they don't qualify for Medicare at all, but they have it through whatever it was that they contributed to.
No, when I graduated college, I went to Kennedy Space Center and was launching rockets, and I got my first check. And that was the first thing I asked was, hey, is there any way that I can, say I don't want Medicare and Social Security and have you guys quit taking this out of my pay? And of course, the answer was, are you kidding me? That's the first question I've ever gotten like that.
Well, I have a first for you all. I am the first person that ever used my IRA to go to a bank to get a loan. And I didn't have any problem doing that. Just like you said, it had to be non-recourse. And I had people telling me all the time they couldn't get their IRA to qualify with the bank. And they said that it's not legal. And I said, well, you could tell them that I did it and this is the company I worked with. And so now, of course, everybody does it. But the company I was with never thought twice about it wasn't legal to do as long as it was non-recourse. So
yeah, but still not every bank does it, but there's a lot of them out there that do. I think people
itself, but it was the IRA company that was saying you can't do it. It's not legal. It wasn't the bank saying that. The banks were happy to do a loan.
Right.
Right. Because they had the security.
Exactly.
They had the real estate. So they had the security, which is what they really care about. Like that. So any other questions or comments or thoughts? For our illustrious presenter, Carl, or
hey Peggy, I have a quick question. This is Kurt.
Yes. Hey, Kurt.
So, howdy. So, my money is in a self-directed 401k. I'm 66 years old. Is there any benefit or any reason why I should move some of that money from the 401k into a Roth? Is there any benefit to me to do that at my age?
What's your, you have to ask yourself that and probably bring your accountant into that. But what's your tax rate now? And the other side of it is when you turn 73, they're going to tell you how much you have to take out of your 401k versus if it's in a Roth, then you're not forced to take money out of it. I always think that you would rather be in a Roth than a traditional. I mean, what do you think? Are taxes going up or down in the future?
They're going up.
So if they're going up, why not pay at the tax rate today? Are you going to be making less in 5 years from now or next year?
That is it. Well, I have done everything I could to reduce my income. Partly because I don't like paying taxes. I'm penalized for, this ARMA tax for Medicare and so on and so forth. I have a couple projects that I'm working that are very promising, which would enable me to make quite a bit of money in my quasi-retirement years here. So, I just don't like paying taxes, period. And I tried to, I guess, get myself in a position last year to lower my taxes as much as I could. And then again this year, it just is not happening the way I hoped. So I guess the question really gets to not being impacted by these taxes long term. Once I do have to take the money out, and you're telling me if I put it into a Roth and pay taxes now, I'd be better off after I'm 72, 73, once I start taking money out.
Not necessarily. I look, Kurt, every dollar you earn in your traditional IRA, you're going to have to pay taxes on. The thing that's making the most money should be rolled into your Roth because it's going to grow. So the whole idea, right, when we opened our 401s or our IRAs, was that we wanted to build it into something. What we didn't realize when we did the traditional was we're going to have to pay taxes on all the money it earned. So the idea is to get it out of your regular traditional, get it into your Roth so that you're not paying taxes on all the money it earns. The Roth is tax-free.
Yeah, think of it as this. If you convert, an amount from your traditional to your Roth, and you're in the, let's say, 40 or 45% tax bracket now, and you're making 15% return on that money, you've made that up in 3 years. So you've paid back your taxes in 3 years, and the rest of your life, and 10 years after your life, that Roth money, that 15% is all now tax-free. So being 66 is, I don't think I think it's still a good idea to look at it. Unless, what's going to happen to your money when you pass? Is it going to kids? If it's going to kids, what tax bracket are they going to be in at that point? And will they have to pay the taxes when they pull it out? If they're destitute or in a low tax bracket, then that might give you a reason not to do it. But I'm almost certain in almost all those cases, 75% of the time, I would say convert.
Okay.
And convert a little bit at a time if, it makes swallowing the pill easier.
Exactly.
Got it. Well, thank you.
I'll roll up. Let's say I had $100,000 deal. I'll either roll it over 3 years or over 2 years, all depending on what my accountant tells me I could do.
And the other thing is, you can also convert assets, just like the house we talked about. It could be a note or a mortgage, right? Or shares in an LLC. And if those lost value and you got them appraised, you could convert that asset into the Roth and save money on that. As an example, there was one guy that paid $350,000 for a house in 2000 and I think it was 8 or 9, and because it had dropped from $550,000 in 2010, that house went from 350 to 150. At that point in time, they put a non-recourse loan on it for $75,000, and then converted the house, paying taxes on $75,000. So, and since then, the property's gone up to $450,000, and they only paid the tax on the $75,000. So, when life gives you lemons, turn them into lemonade. Talk to people, and you get some pretty good strategies out there.
Got it.
Are there any other questions? Because we are at the top of the hour. Well, we thank you all for coming. And here's somebody jumping in at the last minute. So we thank you all for coming and all your great questions. We really appreciate Carl, you and Samantha coming and explaining about how your company works. And if you all have any questions or you want to learn more, put your email in the chat and they will get in touch with you. So thank you very much for coming, and we will see you again.
Yeah, if anybody wants a copy of this presentation, we'll send that to them if you give us your emails. Samantha will.
Okay, or you can send it to us and we'll send it out to everyone.
Okay, we can do that.
Okay, thanks.